Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Commercial Mortgages for Convenience Stores UK Guide. Entering the world of commercial mortgages can be a daunting task, especially when it comes to financing convenience stores in the UK. Navigating the intricacies of the commercial mortgage landscape may seem overwhelming, but with the right knowledge and guidance, you'll be well prepared to make an informed decision for your business. Understanding commercial mortgages. When considering a commercial mortgage for your convenience store, it's essential to understand what it entails. A commercial mortgage is a loan secured against property that is not your residence, such as a building used for your business one. Just like residential mortgages, commercial mortgages allow you to buy a property for your business operations but come with their own set of terms and conditions. Firstly, you'll need to consider the term of the loan. Commercial mortgages typically have a loan term of 15 to 25 years too. This can give you ample time to pay back the loan, but keep in mind that the repayment period is usually longer than residential mortgages. Interest rates are an essential aspect of commercial mortgages. They can be structured using fixed or variable rates. Fixed rates provide predictability in your monthly payments, whereas variable rates can fluctuate depending on market conditions. It's crucial to choose the most suitable interest rate structure based on your business's financial situation. Additionally, commercial mortgages may require a higher deposit than residential mortgages. This can range from 25 to 40% of the property value, and it's essential to have the funds available as this can be a significant financial commitment. As a business owner, you also need to consider some unique factors when applying for a commercial mortgage. Lenders will assess your business's financial health, including income, projected revenue, and credit history. Be prepared to provide detailed financial information to support your application. In conclusion, understanding commercial mortgages is vital when exploring financing options for your convenience store. Take into account the loan term, interest rates, deposit requirements, and your business's financial health to ensure you make an informed decision. Why opt for a commercial mortgage? When planning to buy or refinance a convenience store, opting for a commercial mortgage can provide you with numerous advantages. Here's why. Firstly, a commercial mortgage offers you a sense of security. By obtaining a mortgage secured on the convenience store property, you can ensure that your investment is tied to a tangible asset. This means that, should things not go according to plan, you still have the option of selling the property and recovering some of your invested capital. A key benefit of commercial mortgages is their generally competitive interest rates. Since the loan is secured against the commercial property, lenders often provide more attractive rates compared to unsecured business loans. This helps minimize your borrowing costs, maximizing the potential profit from your convenience store. In addition, obtaining a commercial mortgage for your convenience store provides greater flexibility in terms of repayment. Mortgage terms can be negotiated and tailored to suit your financial situation and plans for the property. Furthermore, commercial mortgages typically offer longer repayment terms than regular business loans, providing you with ample time to manage repayments and run a successful convenience store. When selecting a commercial mortgage for your convenience store, it's essential to consider the deposit requirement. Most lenders ask for a deposit ranging from 25% to over 40% of the property's value. This may initially seem like a considerable outlay, however, a commercial mortgage allows you to spread the cost of the property over an extended period, enabling you to effectively manage your cash flow. By opting for a commercial mortgage, you're positioning yourself to take advantage of tax benefits. The interest on your commercial mortgage is tax-deductible, which means you can reduce your tax liability while investing in the growth of your convenience store. Overall, a commercial mortgage offers you security, competitive interest rates, flexible repayment options, and tax benefits, making it an attractive financing option for your convenience store in the UK. Eligibility and requirements. When considering a commercial mortgage for your convenience store, it's important to understand the eligibility criteria and requirements. These factors can influence your chances of approval and the overall success of your application. To begin with, be prepared to present a comprehensive business plan. This document showcases your strategy, financial projections, and how you intend to tackle the competition. A well-structured business plan demonstrates your commitment and foresight to potential lenders, increasing your chances of securing a commercial loan. Experience in managing or owning businesses, particularly in the retail and convenience store sectors, is a significant factor for lenders. If you have a proven track record of success in similar ventures, it may instill confidence in lenders that you're well equipped to manage the business and repay the loan. Your eligibility for a commercial mortgage is also influenced by your credit history, both personal and business. Lenders usually assess your creditworthiness to determine the level of risk associated with the loan. Maintain a good credit score by paying bills on time, keeping debt at manageable levels, and promptly addressing any discrepancies in your credit report. Commercial loans for retail properties, especially convenience stores, typically offer a loan-to-value ratio, LTV, of 70% to 100%, subject to your financial status and the lender's terms and conditions for. Be prepared for a mortgage term ranging from 15 to 25 years. 5. Moreover, you'll need to provide detailed information about your business operations, financial performance, and market research. Lenders may also require an appraisal of the property, so ensure it's accurately valued before you submit your application. In summary, to improve your chances of being approved for a commercial mortgage for your convenience store in the UK, focus on presenting a solid business plan, demonstrating relevant experience, maintaining a strong credit profile, and providing comprehensive information about your business operations and finances. By adhering to these guidelines, you'll build a formidable case for your loan application and make headway in securing the necessary financing to grow or establish your retail venture. Applying for a commercial mortgage. When looking to secure a commercial mortgage for your convenience store in the UK, it is essential to understand the application process and criteria. As a business owner, you will need to gather the necessary documents and prepare your financial records. Here is a brief guide on applying for a commercial mortgage for your convenience store premises. Before starting the application process, ensure that you have all the essential documents at hand. This includes proof of personal identification, trading history, business accounts, and property details of the commercial premises you wish to purchase or refinance. Having these documents ready will help speed up the process and improve your chances of securing a favorable loan. As a business owner, it is important to research the commercial mortgage market to find the best mortgage for your convenience store. Each lender will have their own criteria, and it is crucial to understand what they require in terms of creditworthiness, debt service coverage, and property conditions, among other factors. Don't be afraid to shop around and compare different mortgage products to find the most suitable option for your needs. Once you have chosen a lender, you will need to complete their application form. This typically involves providing details about your business, your personal finances, and the commercial property in question. Ensure that you provide accurate information and be prepared to back up any claims with relevant documentation. It's essential to be honest and realistic when giving information about your business's financial situation to calculate the debt service coverage. During the application process, the lender will likely request additional documentation and information. Be prepared to answer any questions and provide the requested materials promptly. Failure to do so might delay or even jeopardize your application approval. In some cases, you might be required to offer additional security or a personal guarantee to secure the commercial mortgage. Upon approval of your application, the lender will provide a formal mortgage offer. This will include the amount of credit, the interest rate, and any other relevant terms and conditions. Ensure that you carefully review the offer, and if you find it agreeable, proceed with the final steps of the transaction, which may involve legal and valuation work or fees. By following this guide, you can make the application process for a commercial mortgage for your convenience store in the UK less daunting. Just remember to take your time, do your research, and seek professional advice if needed in order to secure the best possible mortgage for your business. Cost considerations and repayment terms. When considering a commercial mortgage for a convenience store in the UK, it is essential to understand the various cost considerations and repayment terms available. Here, we will discuss some key factors that you need to be aware of while arranging a commercial mortgage. A commercial mortgage can have terms ranging from 15 to 25 years, with loan-to-value (LTV) ratios typically between 70% and 100%, subject to your circumstances and the lender's assessment. To estimate your monthly payments, you can use a commercial mortgage calculator, which breaks down the total amount repayable into monthly payments and interest costs. Interest rates for commercial mortgages can vary and may be either fixed or variable. For example, fixed-rate products may have an early repayment charge that applies to overpayments and will be detailed in your facility offer. Rates for owner-occupied businesses in 2022 start from around 2.25% above the base rate, with a sweet spot of 65% LTVs for most cases source. In addition to interest rates, other costs you need to be aware of include arrangement fees and security fees. Arrangement fees are charged by lenders for setting up the mortgage and typically range between 1.5% to 2% of the loan amount. These fees can often be added to the loan account, which provides more flexibility for you as a borrower. Security fees are the costs associated with evaluating and registering the property used as collateral against the loan. These may include valuation fees and legal fees, which vary depending on the lender and the complexity of the property transaction. It is also possible to negotiate a capital repayment holiday with some lenders. A capital repayment holiday allows you to make interest-only payments for a certain period, providing you with more cash flow flexibility in the early stages of your loan. However, keep in mind that this may increase the overall cost of borrowing, as the total loan amount will take longer to pay off. In summary, when arranging a commercial mortgage for your convenience store, carefully consider the repayment terms, interest rates, arrangement fees, security fees, and the possibility of a capital repayment holiday. By doing so, you will have a better understanding of the costs involved and choose the most suitable mortgage for your circumstances. Comparison between residential and commercial mortgages. When you're considering financing options for a convenience store in the UK, it's essential to understand the differences between residential and commercial mortgages. These distinctions will help you make an informed decision and choose the right solution for your needs. Firstly, the loan amounts for commercial mortgages are generally higher, with a minimum borrowing amount often set around £35,001 and no upper limit, while residential mortgages usually have a lower range. The repayment terms for commercial mortgages are also shorter, typically lasting from 1 year up to a maximum of 15 years, whereas residential mortgages can span 25 years or even 30 years. Another key difference lies in the loan-to-value (LTV) ratio. For a commercial mortgage, you'll usually find the maximum borrowing to be within the range of 65% to 70% LTV, whereas the limit for residential mortgages can reach up to 95% LTV. This means that you will need to provide a larger deposit for a commercial mortgage compared to a residential one. It's also worth noting that the eligibility criteria for commercial mortgages are not as straightforward as for residential mortgages. There are no standard rules like 3 times your salary for commercial mortgages. Each application is assessed on a case-by-case basis. This means that the evaluation process for commercial mortgage applications can be more complex, considering various factors like business performance, financial history, and creditworthiness. Interest rates for commercial mortgages can also vary widely. In summary, while residential and commercial mortgages share some similarities, there are distinct differences in terms of loan amounts, repayment periods, LTV ratios, eligibility criteria, and interest rates. It's crucial to educate yourself on these variances and consult with a professional advisor if needed, to ensure that you make the best choice for financing your convenience store in the UK. Benefits and risks. When considering a commercial mortgage for a convenience store in the UK, it's essential to weigh up the various benefits and risks associated with such a financial commitment. This will enable you to make informed decisions for your business. Benefits. One significant advantage of obtaining a commercial mortgage for your convenience store is the potential for increased financial flexibility. When you own your retail property, you're in a better position to negotiate more favorable terms on your loan, which can lead to lower interest rates and more manageable monthly payments. Another advantage of commercial mortgages is the opportunity for long-term investment. Purchasing a property can provide a sense of stability and security, allowing you to focus on the day-to-day operations of your business. Furthermore, as the property appreciates in value over time, you can build equity which can be leveraged for future expansion or investment. Lastly, owning your property gives you greater control over your business space. You can modify, expand, or redesign your premises as you see fit without having to seek approval from a landlord or managing agent. This allows you to adapt your business to meet evolving customer demands and market trends. Risks. While owning your convenience store's property is undoubtedly an attractive proposition, it also comes with certain risks that you need to take into account. A significant concern is the fluctuating nature of commercial property values. If the value of the property drops, you may find yourself struggling to sell or refinance the property at a later date. Additionally, securing a commercial mortgage can sometimes require a more substantial deposit than a residential mortgage, which can be a financial strain on your business. There's also the possibility that your mortgage repayments could change over time due to factors beyond your control, such as interest rate movements, affecting your cash flow and overall financial performance. Lastly, managing a commercial property can also be time-consuming and costly. You will be responsible for maintaining the building, managing the tenant mix, and dealing with any repairs and upgrades. These factors can impact your ability to focus on running your convenience store effectively. Considering these benefits and risks, it's crucial to evaluate your business needs and financial capabilities thoroughly before deciding on a commercial mortgage. Remember to consult a professional advisor for guidance tailored to your individual circumstances. Loan-to-value, LTV, and security. When you're considering a commercial mortgage for a convenience store in the UK, the loan-to-value, LTV, ratio and security play vital roles in the process. LTV is the percentage of the property value that you can borrow, with the remaining amount typically covered by a deposit. The LTV ratio for UK commercial mortgages usually falls between 60% and 75%, and this would be applicable for convenience stores as well. To calculate the LTV, simply divide the mortgage amount by the property value and multiply the result by 100. For example, if you intend to borrow £500,000 for a property worth £750,000, the LTV would be 500,000 divided by 750,000 times 100 equals 66.67%. In this case, you would need a deposit of £250,000, which represents the remaining 33.33% of the property value. However, it is possible to obtain a higher LTV, even up to 100%, if you can provide additional security for the lender. This security could be in the form of another property or asset that you own. By offering such collateral, the lender will have the assurance that their investment is protected, even in the event of a default. Keep in mind that obtaining a higher LTV might require a robust business plan and a strong financial history, as lenders will want to minimize their risk exposure. Moreover, a higher LTV will likely lead to higher interest rates, as the lender perceives more risk in the loan. In conclusion, while seeking a commercial mortgage for a convenience store, make sure to pay close attention to the LTV and security requirements. Understanding these aspects will help you make informed decisions and potentially improve the terms of your mortgage. Finding the right lenders. When searching for a commercial mortgage for your convenience store, it's crucial to find the right lender to suit your specific needs. There are lenders to choose from, however, it is important to choose the right lender for your case. Specialist commercial finance brokers like us can help you navigate the market. In order to find the best lender for your situation, it's essential to thoroughly research and compare the offerings of various lenders. This can involve checking their interest rates, fees, and terms and conditions. Additionally, consider looking for lenders that have experience in lending to convenience stores, as they may have a better understanding of your specific needs and challenges. One strategy to find suitable lenders is to consult with a mortgage broker who can tailor mortgage solutions to your needs. By working with a broker, you benefit from their industry knowledge and established relationships with various lenders. This can often lead to advantageous deals that might not be available if you search for a mortgage on your own. Keep in mind that the application process for a commercial mortgage can be more complex than a residential mortgage. Lenders typically require more information like business plans, financial projections, and a thorough evaluation of your convenience store's location and market conditions. Therefore, having a well-prepared application, along with the support of an experienced broker, can increase your chances of securing the best deal. In conclusion, finding the right lender for your convenience store commercial mortgage requires due diligence and careful consideration. By researching the market, comparing lenders, and working closely with a knowledgeable broker, you can find a mortgage that best fits your needs and enables your business to grow and prosper. Special considerations for convenience stores. When looking into commercial mortgages for convenience stores, there are a few unique factors that you need to take into account. Understanding these considerations will help you make the most informed decision for your business. Firstly, the location of convenience stores is essential to their success. You need to ensure that the shop is situated in an area with a good footfall and customer base, like near a residential area or on a busy road. Being close to other complementary businesses, such as NISA outlets, can further increase your store's visibility and potential customer base. Additionally, many convenience stores are part of mixed-use properties. This means that the property might not be solely used for the store, but also include residential units or other commercial spaces. In such cases, you need to ensure that the mortgage products you are considering cater to mixed-use properties like these. Another crucial aspect to consider is the business viability of the convenience store. This involves evaluating the store's financial performance, both past and present. While applying for a commercial mortgage, lenders would look at your credit score, trading history, and cash flow to determine the financial sustainability of your business. Make sure these factors are strong to increase the likelihood of approval for your mortgage. To summarize, when considering a commercial mortgage for convenience stores, you should focus on location and accessibility, potential ties with popular chains like NISA, compatibility with mixed-use properties, assessment of your business's financial viability. By paying attention to these factors, you can confidently navigate the commercial mortgage market. Make informed decisions, ensuring that you secure the best financial product for your convenience store's success. What is the typical loan-to-value for commercial mortgages on convenience stores? The typical loan-to-value, LTV, for commercial mortgages on convenience stores can vary, but it generally ranges from 60% to 75% of the property value. This means that you would be required to contribute a deposit of around 25% to 40%, depending on the lender's requirements and the specific property involved. Some lenders may offer higher LTVs in certain circumstances, however, this may come with higher interest rates or additional requirements. How do lenders assess affordability for commercial mortgages? Lenders assess affordability for commercial mortgages based on various factors such as your financial situation, trading history, and the projected cash flow of the convenience store. A thorough examination of your business plan, trading accounts, and bank statements will help lenders determine if you can comfortably repay the loan. They may also take into account the location, size, and overall potential of the store, which can all impact its financial success. What types of repayment plans are available for convenience store mortgages? Repayment plans for convenience store mortgages usually include capital repayment mortgages, where you'll make monthly payments towards both interest and principal, and interest-only mortgages, where you'll pay only the interest during the mortgage term and repay the principal in full at the end. The choice of repayment plan can impact your monthly payments and overall cost of the mortgage, so it is important to explore the options and assess which plan suits your circumstances best. Can interest-only mortgages be obtained for convenience stores? Yes, interest-only mortgages can be obtained for convenience stores, however, they may not be suitable for all borrowers. With this type of mortgage, you pay only the interest charges during the mortgage term and must repay the full loan amount at the end. This can result in lower monthly payments but presents a higher risk, as you are required to have a repayment strategy in place to clear the full loan amount at the end of the term. Lenders will assess your ability to repay the principal before deciding if an interest-only mortgage is a viable option. What factors might impact the rates for commercial mortgages on convenience stores? Several factors can impact the interest rates for commercial mortgages on convenience stores, including the amount borrowed, LTV ratio, the strength of your financial history and trading accounts, and the market conditions. Higher LTV ratios generally result in higher interest rates due to the increased risk for the lender. Additionally, a strong trading history and financial position may lead to better interest rates, as the lender perceives a lower risk of default. Are there any additional fees to consider when applying for a commercial mortgage? When applying for a commercial mortgage, you should be aware of additional fees that may be involved. These can include arrangement fees, valuation fees, legal fees, and potential early repayment or exit fees. It's essential to familiarize yourself with these costs to understand the total expense associated with the mortgage and plan accordingly. Always be sure to discuss these fees with the lender or a commercial mortgage specialist to obtain a complete view of the overall costs. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.